All right, a portfolio MRI demonstration by the rookie. This is January 29th, 2014. Okay, give it a shot here. This is to be critiqued by the pack, I suppose. So we've sat down, they've done their homework, they've engaged me at this point. I'm still giving them supporting pieces as we go through the meeting process, and with people that have fairly sizable net worths that typically go a little bit longer, more meetings, a little bit longer conversion time, but it's because they do require more proof of things, more time to absorb any new concepts, etc. But so anyway, this is just whatever got us here. We're here for this portfolio MRI presentation, and this is for critiquing. Just explain basically to folks that what we're really going to do today is we're going to be able, before we're done, the 20 must answer questions that you had mostly no's on, you're going to be able to check yes to about 10 of those or so today. So you'll already be halfway to a greater peace of mind financially, and I think in general as well. So we're going to look at, first of all, historical rates of return so that I can educate you a little bit on the types of what asset classes are, what kinds of returns do they get, and how do they behave in relation to the other asset classes. So we'll also factor inflation in there. And then we're going to also take your current mix of portfolio, which has been entered in, and we will have it against the academically based 4 model portfolios that are asset class based portfolios, which you'll understand what that means as we go on. And we'll look at the historical risk versus reward, and once again how they behave in relation to other asset classes, pieces of the portfolio. And then we'll finally give you that risk number. That'll be one of the questions of the 20. You'll actually be able to say, I know what my current risk number is, and I know exactly what it means. And I know that if I want to improve it while not giving up return or even possibly improving return, which is really the end game of what we do here with free market investing, that's it. So basically we know from studies that over 90% of a portfolio's performance is how it's allocated. It will behave positively, negatively, whatever it does, based upon how it's allocated. Not who's picking it, not alpha from the manager, not market timing, not anything else like that. So moving on, we will look at, as promised, the performance of various investment asset classes. And to the far left, we just have the U.S. inflation rate. Now we know the inflation rate is not an asset class, okay? But it does have a number of what it has, a percentage it has risen on average over the years or over a period of time, okay? We also have some other factors here to show you and compare how these all behave so differently and how inflation factors into all of them, as you would imagine. So what we're looking at is we have U.S. Treasury bills, long-term U.S. bonds, U.S. large and small stocks, international large and international small. These are the historical asset class returns over the 40-year period from 1973 to 2012. A fairly long period to have a reasonable amount of confidence, that the risk numbers and the expected returns for those risk numbers are going to be relatively within reasonable proximity, for lack of a better term. So second line is easy. It's the inflation rate. It applies to everything. So what we're taking is the annual return, average annual return over the time period for each asset class, subtracting out the inflation rate. It's not exactly subtraction because these are points in time. So engineer types will definitely may call you on that and say, wait a minute, if I subtract this from this, okay? So here's the real return. We all know that there's no real return if we don't have some measure of risk, but that's really the whole rub here, in which what we will hopefully be able to bring clarity to you. Okay, so the real return is really what your buying power is. And then it shows the amount of negative years for the asset classes out of 40. So you see, even U.S. government bonds had negative years, and they're sometimes perceived as safe instruments. And then at times they're anything but. This is the number of positive years. So now you're able to see the range. And this is how we're going to look at all the portfolios too, as well as parts of your portfolio. And we have the years, as I've mentioned, down here. And then we have something called, this is your risk number. This is called standard deviation. You know, it's a probability, it's a statistics term. It's the middle of the bell curve. It's what happens 2/3 out of most of the time. This is the swing of these various asset classes most of the time, 67% of the time, 2/3. So, in other words, 2/3 of the time historically, this particular asset here has the hand underneath it will not be up more or down more than 24.73% or somewhere close to that. Okay, that doesn't mean that it can't go higher or lower than those ranges, because there is that other third of the time that it will be an outlier. That does happen, but as you can see, there are more up years than down years on all the asset classes by far. Okay. Now, basic investment objectives, you can just read this, but these are pretty much academically defined strategies. Do you have one of the 20 questions was, do you have a specific strategy that you know that you're consistently maintaining at all times? You know what you're doing at all times. Well, this is the beginning of the root of it all. This defines conservative, moderate growth, and you really pick your portfolio with my coaching help, but it's really not up to me as the ultimate decision. It should be one that you arrive at with my coaching help. Okay? And I'll discuss with you on how to read the charts. And so here we go. This is one of the two most significant things that how useful I find this report. I'm going to shrink it just a little bit so we can get more of it on the screen. Okay, here are those academically based 4 different types of model portfolios. They all have the same comparative data. And the sample client mix is your mix. So your actual investments were entered in here through the Morningstar interface, and now this is where you lie compared to the established models, and you can see now what areas you may be too heavy on, some areas you may be not heavy enough at all, and there might be some that you shouldn't be in at all, period, and I'll explain why. So this is you, even though this is just a sample client mix, okay? And this shows that right now, because you're in a transition period, you have an enormous amount of cash as far as your fixed income portion of your portfolio goes, and I know that's because it's semi-temporary, but you've been paralyzed since the market meltdown, and it's at a crucial point in your life that I can understand why, if you don't know what else to do, you just grab on to what you have. So let's take a look at this. I mean, you have no short-term fixed income, and that fixed income is really just bonds, and that's short-term, intermediate, and long. Now, compared to all the other models, it's less prudent to not have any of these short-term fixed exposure at all. And as you can see, even in portfolio, conservative or portfolio, you're looking between 25 and 37% of your fixed income portion should be short-term. Short-term and intermediate term have less risk than long-term bonds because it's easier to predict interest rates and bond prices in shorter periods than longer. Isn't that right? I mean, I could plan maybe 10 years ahead for my business, even that's kind of long, but any longer than that I'm not comfortable with. So there's a great risk in there. So how do you price that? So there is a lot of risk in those, and that's why in our academically based models, the long-term bonds are left out completely. They've been proven to add absolutely no benefit whatsoever because they have equity-like standard deviation or risk, but they don't ever bring the equity return that you'll see or that you saw with the asset classes up here before. So getting back to the first third here, you have your fixed income, and you can see here where we would be able to get these closer to which model is most comfortable with your risk level, not your return level. I want you to focus on the risk when we get to the charts, not the returns. U.S. equity, okay? You have a reasonable exposure on the large value, and even the large stocks, but you have absolutely no small stocks and no small values, and all the other models have them proportionally. And not having them does two negative things to your money. First of all, it makes it more risky, and it's also giving you less return over time, more than likely than what you would be getting now if you stayed the same. Okay, so we would get these things realigned, and it would be maintained along these lines, these percentages, within a certain amount of tolerance. Excuse me. We have international equity, and once again, you don't have any small stock exposure to that, but we have a very prudent way of getting that exposure in a cost-effective manner. You're actually way heavy on large stocks international, because over time, large does not outperform small. Small outperforms large through time. That's one of our three-factor models we'll talk about later. Okay? And there you go. So here's just a graphical representation of what we just looked at, and if you just want to look at it sort of on an intuitive basis, you're looking at, here's your client mix. This is cash. These, even if you didn't know anything about these, they just seem like they're more balanced. I see more colors there, but it's not just a pretty picture. These are academically engineered based on modern portfolio theory. Okay, now in this section, if you're an engineer type or something like that, or you have a background in stats, then I can go into this a lot. But I don't like to get too technical, because I think I've already gotten too technical, honestly. But when I explain correlations, I just say, you see all those numbers are different, okay? They don't all behave the same. And each one of them, compared to any other one of them, anytime you pair any of them up, okay, there's a certain amount that they're alike, and there's a certain amount that they're different. Some assets, there could be everything different. So this just shows you that there have been numbers assigned to all the different asset classes that one could have in this type of portfolio. And you want, this explains correlation, and if you'd like me to explain it fully, I'd be happy to. But what this is leading up to is showing that you want as many of your pieces to fall within these two areas, the dark blue and the light blue, as many as you can get around there, because you're going all the way from -1 to +1. That's the whole range of correlation, and you don't want to have too much to one side, because then it is not as diversified. So this is all about diversification, and this just shows that by having all of the assets that are proven to be that are actually engineered in these portfolios, they essentially, I think we'll just cut this part out, okay? Going on way too long for it. Now, this is the last really significant thing, but this takes a bit of a preface. This requires a little bit of a preface. So, once again, just like when we were looking at how your assets were compared to the 4 established models. Well, now here what we're doing is the same thing with those same established models over the same time period. We have your sample mix, except your sample mix, we're giving you 3 things that you don't have. One, that you've had this exact allocation for 40 years, okay, and that you've consistently rebalanced it, that you've never left the market and gone to cash and tried to time the market, and that you haven't tried to do any kind of stock picking. And so your return is going to be significantly higher with us giving you those three things that you couldn't possibly have. No one could. No one walking through these doors could. I couldn't before either. Okay? But the standard deviation number here, I believe, is far more reliable of a not just a long-term view of something. But so if you see with your current mix that your annualized return over all that time with those three perfect things that we know weren't done is 6%, how do you think over the long haul, over 40 years, if you would have, at least just kept this mix and just left it that way, would have it returned? And I really can't say what it would be. We really don't know. But I could say this: it's going to be something less than this. That's for sure. These are not actual portfolios of historical performance of specific portfolios that we manage. We explain everything in the end notes of how it is, of how these are determined. But as you can see here, high standard deviation risk, bad if you are a conservative person. But you see the annualized returns that the more, when you go from the more moderate, conservative, moderate to more of the growth and aggressive, it's a bumpier ride. Excuse me. But the return in the long run is considerably higher. So what we do with these portfolios is we're able to, they've been engineered to, through diversity, to actually improve, or at least not give up, return, but with less of a bumpy ride, with a lower risk number. Okay? See, the problem with portfolios when people buy active mutual funds is it's like the Tower of Babel. No one in your portfolio is communicating because they don't speak the same language. They're not working on your portfolio. They're just doing their thing. And if you even went into something that remotely resembled, say, a 50-50, a fixed income active mutual funds and equity active mutual funds, if they're not consistently rebalanced in harmony with your portfolio especially, okay, it will morph into something else over time. It won't stay exactly 50-50 where you started. It will, one half of it will shrink through a certain period of time and one half will expand, and it will become something else other than what you originally did in the first place. And that's what happened to people in the meltdown, because their plans, even if they started with an allocation, they aren't maintained, and they become something else that has much higher standard deviation or risk than what they'd ever be accustomed for. That's what leads to the panic. It's one of the many things that leads to the self-destructive behavior of pulling your money out of the market at the very worst time. Okay? So you want to always try to keep standard deviation lower if you can without sacrificing any of your returns. That's a double winner in my opinion. Okay? Here just what shows what the growth of $1 in each of these, just to give you a very simplified, broken down to $1 perspective. Okay? I haven't found that to be super duper useful. I mean, this is just a graphic showing those asset class returns compared to inflation. And then as we would show you even on our portfolios, before you look at the mixes, you still want to look at your current client mix. And remember, your numbers are better than you could have done on your own. I'm not trying to be mean. It's just strictly you have to understand that. But I can't give you a number because that would be it would be untruthful. It would be inaccurate because there's no way of really knowing. But you can know one thing, that it will not be optimal like that. It would be something less than that. Okay. So at this point, the last piece I'd like to do today, because I'm sure I've given you enough information at this point to fry your brain out, but is where you plot here on the Markowitz. This is the Markowitz Efficient Frontier, 1990. He won the Nobel Prize. It's all based on the concept of modern portfolio theory, and basically If you're not comfortable with charts and stuff like that, I will try to just say it as simply as I can. You have an x-axis and a y-axis. The x is that standard deviation. This could be construed as a percent. So this here, for instance, is a 6% up or down, plus or minus volatility. If something plots here, if something plots here, it's 12 plus or minus. Okay? So this is the line that shows the optimum return you should get for the level of risk that you're getting. So the y-axis is your compound returns. So the more risk you take in these defined models, the greater the return. But let's see where you mapped out. Okay, we're going to open up your booklet, which you can't see on this video. Okay, and we're going to look at your annualized return. Now you can put 6.17 if you want. I'm not trying to juice the numbers, but we know that for the third time that it's going to be something less than that. It's up to you. But we can probably be pretty comfortable with the standard deviation to some degree and plot that. So your risk is about here because you have so much cash, and your return is here. Okay, so anything under this line is inefficient. Because one thing I forgot to tell you, the whole philosophy of the theory is that the markets are efficient and that all knowable information is built into stock prices almost instantaneously. So anyone that really thinks they can be arbitragers or find price discrepancies for very long periods of time, even if they think they're sophisticated, is not something that can be relied upon. It's only going to be luck if it does work out. And that's what happens when something's over this line. Anything over this is alpha. That means like something they're doing. They're not giving up any risk, but they're getting this return. There's one thing I can always tell everybody, that anything that goes up here will not stay there indefinitely, and it won't stay there very long. And when it does bop out, it's going to become very inefficient. So anything up above here is hyper efficient, which is alpha, which cannot be maintained unless the markets were inefficient. Anything below means you're taking more risk than what you're getting in return. And every single person that's ever walked through my door would fall somewhere under here. And you even look at the S&P 500. Why was that put in there? Well, because first of all, the S&P is just an index, doesn't have expenses, doesn't have timing. Okay, but look at it, shows you that the volatility is over 18%, 2/3 of the time, standard deviation. Okay, and its return for that time period is maybe 9.5. And why is that? It's a bunch of different stocks. Well, the reason is because even though it's 500 stocks, it's 500 large U.S. stocks. That is only one asset class. So it's not diversified. It's got a bunch of the same kind of companies in it. It's diversified in that respect, but it's not truly diversified for a portfolio. Okay? Because this is a wild ride for this kind of return. For this kind of return, people were only having 8% swing instead of 18, 19. So you tell me. I think I'd rather make the same or more with a lot less nail biting if I can do it. And I'll show you as we go through our coaching and through our initial meetings how we can get as close as we can to getting you the best, not giving up any returns, but while you have a more prudently risk-controlled portfolio design. You know, when you can finish up, I'd expect you when you get back, you can read at home the top 5 reasons why I've affiliated myself with Manson Money, and why you benefit from working with me through them as a co-advisor and as a coach for you. And next time what we'll do is we will go through your overlap report, and I'll show you areas that are causing that lack of diversity in your case, which is really increasing your risk and robbing you of returns. And we'll look at that, and then I will go over once again the philosophy, the 3-factor model, so you just have an idea. And I'm not trying to make an expert on this if you don't want to be, but I have to tell you that I believe that every investor should have at least a basic knowledge and be able to answer those 20 questions. Once after that, you don't need to know anything else. You don't need to know everything. It's important that you just need to know the few important things. Well, guys, that's not necessarily exactly how I always do it, but I'm open to whatever your critiques are, and thanks.